Good morning, everybody. It is Friday, August 21st, 2020, the year that nobody expected. I'm Kirk Spano, Fundamental Trends, Margin of Safety Investing, and for those of you who aren't aware, I am an investment advisor who hasn't really been taking new clients for the last, I don't know, 4 years. But I made a decision over the last few months that I'm going to start taking clients again. It's going to be a limited engagement event. I probably won't take any new clients after the end of the year. I'll take new clients through the end of the year. And the reason I'm going to do it is because I expect an incredibly fast change to occur based on whoever wins the election. And I think that we are going to see tremendous volatility after Labor Day. I believe that if President Trump wins, that we will have another 2000 to 2002 period, but with stagflation. So that would be a rolling long-term bear market with difficult conditions at the household level due to inflation and unemployment. If Joe Biden wins, I believe that we have a transition from a monetary regime to a fiscal regime that will cause short-term pain in the markets. However, we will start building from the middle out again, and it will look a lot like the Obama years, except that if you read Biden's outline of policies, he is likely to, he's saying that he's going to be a lot more progressive, especially if he gets the Senate. So we don't know what the outcome will be in early November. I have private polling data that gives me a pretty big clue, and it really just comes out to turnout for the Democrats. If the Democrats turn out 66, 67 million voters, it'll be a neck and neck race. If they turn out 70 to 75 million voters, which would be a record, although I think barely, it'll be a landslide. So we will see if the Democrats can turn out the vote or not. I don't know. I know that young people are notoriously cynical and frankly freaking lazy when it comes to voting. So we will find out what happens. I did watch Joe Biden's speech last night, and I was waiting for it before I made this announcement. I think it is clear that he is not senile. I think it is clear that he is up to the task. And I think that because of that, it'll be a horse race to the finish line. I don't know if he wins going away or if he loses at the wire. We'll find out. Either way, the reason I am going to be managing money again is because I've seen this game before, twice, and I believe that this will be a 3, 4, 5 year period for me to get pretty wealthy. So I'm going to help make other people wealthy, because in either situation, either winner, there's going to be money to be made. Frankly, there's probably more money to be made if Trump wins, because crashes you can get stupid rich on. And the misperception of the narratives, the glomming on to the idea that the money printer go burr, right? This idea that the money printer goes burr will keep the markets up forever is fabulously wrong. Fabulously wrong. And I don't know where I put the quote. Maybe it was in this article. Stanley Druckenmiller, I made some money predicting boom bust cycles. It's what I do. Sometimes I'm right, sometimes I'm wrong. But every bust I have seen was preceded by an asset bubble generally set up by too loose policy at the Federal Reserve. You can argue with me until you're blue in the face. You can tell me I don't know what I'm talking about, that I'm crazy, that it's different this time, that stocks only go up, just like real estate only goes up in 2006 and 7, and then oops, 8. If Trump wins, stock market has a massive reckoning that's complicated by a weak economy that probably shows stagflationary signs. If Biden wins, we have to go through an adjustment period of building from the bottom up and the middle out. Stocks won't like that. Why? Because the regulations and the rules will change, and the Fed won't be pouring money on top of anything. And really, the Fed, in the last several months, has been the reason the stock market went up so much. I didn't think it would happen this way because I didn't think that they were going to push this much money into the market. But that's what's happened. And the younger investors have taken it upon themselves to use margin and buy a lot of calls on their favorite 20 or 30 stocks. When you take a look at the different charts, and you can find them all out there, hundreds of them, you see that the top 5 stocks in the stock market are something around 35% of the market cap and the gains. In fact, I retweeted somebody this morning, Mr. Northman Trader. 7 stocks now equal 39% of US GDP, and the Fed now equals 36% of US GDP. That is the largest concentration of wealth in the history of the universe. It means that not that many people are doing great. It means that there has to be an unwind. And when the unwind comes, we know, the smarter people know, the people with experience know, people who understand the underlying structure of the market know, it doesn't end well for a lot of people. There's this idea out there that there's a lot of money just waiting to flood into the stock markets. I will use my farmer term for that again. Bullshit. The younger investors are small investors. They're already leveraged up. They don't have cash. The older investors have been leaving the stock market in record amounts, not because they expect to flip trade this, but because they're paying off their houses. They're making sure they have money in the bank so that they can get to the finish line. If you're 70 years old or 80 years old, most of you aren't looking to reach out for risk. You're just saying, look, if I live to 100, I've got my $2 million, my $3 million. I can live making 1% on that money in the bank because my banker works out a deal for me, and they do. If you go to the banker and say, look, I'm going to put $250,000 in your bank, hook me up with an FDIC interest instrument that gets me the, gets me 1.5%. It's out there, and they take it. And a lot of people are taking the crazy, stupid fixed annuities, record sales there, with no hope of ever making more than 3 or 4%, but they don't care because they think they have principal protection. Not true, because it's only as strong as the insurance company issuing that annuity. And I will tell you that half of the insurance companies on the life insurance and annuity side are in trouble. I was a record-breaking salesman for annuities in 2007 and 8. Why? Because I was pulling all my clients' money, all the stock markets, stick them in annuities. And you know what? For the 5 to 7 years that I had them in annuities, and most of them were variable annuities with guarantees or index annuities, Not only did we not take a loss during the financial crisis, but we participated in most of the upside of the stock market coming out of it. Because the contracts back then at higher interest rates, which backed the bonds, that backed the annuities, gave us a high participation rate in the stock market. Today's annuities, index annuities, variable annuities, because interest rates are super low, the participation rate on the index annuity is crap. You're capped out at about 4% in most cases. Or there's this big spread. Or the way that the mechanics of the formulas work. And I don't care if you're looking at Aviva or John Hancock or Nationwide or anything out there, or Allianz, it doesn't matter. The annuity products out there are so bad that when inflation comes, and it's coming, because the deflationary wave is just about over, we're about to enter a neutral to growth period in the economy due to the millennials that's fueled by mountains of liquidity that's not going into the stock market, it's going into the bond market, and it's getting locked in because the bonds are owned by the annuity companies. Now, your private equity companies, the smart ones, have been hoarding cash. Why? Because how do private equity companies work? They're vulture investors. They will wait for the stock market to crash and for companies to go out of business, and they'll cherry pick. That's already starting to happen. We're seeing this wave of blank check companies called SPACs, special purpose acquisition company. Nikola came out of a blank check company. I told you about it when it was $11 a share. Now it's 40 or 50. I didn't pound the table on that one. Maybe I should have. But I told you what I thought. And I leave it up to you to make your own decisions, because if I pound the table on something and I'm wrong, oh, that guy's an asshole. If I pound the table on something and I'm right, you were smart for buying it. So I don't pound the table very often. But I pounded the table last week telling you this is about your last chance to raise cash. Sometime between now and the end of the year, we're going to see a wicked correction. I told you that last December and January. The market peaked at the end of January, middle of January, whatever it was, chopped along, and then fell off the cliff. That correction in the spring was going to happen either way. The underlying structure of the market dictated it. The charts here essentially match what was going on in January. Right there. And then there. Now it's back up. It barely even moved on that measure. Overvaluation. Globally, overvaluation. Right before it fell, it's right back there. And it took trillions and trillions of dollars of Fed money to do that. Why? Because the leverage in the system through the derivatives, through the credit default swaps, through all the different counterparties, all the trillions and trillions and trillions of dollars of derivatives that are worth something like 300 times more global GDP. Some stupid number. I don't even know what it is. It's gigantic. It's one of those numbers that's so big that's like trying to calculate space travel at the speed of light to something that you can't see. That's what the debt and the derivative markets are like right now. There is so much debt on the planet that we're more likely to end humanity than we are to pay off those debts. Think that through. The derivative contracts are all tied to each other through the counterparties. They can't possibly pay the debts that are coming due. So just like when Bear Stearns tipped over and then Lehman Brothers tipped over, it is 2 or 3 times worse today than it was in 2007. Why is that? Didn't we put in new regulations? We did, but for the last 3.5 years, we've watered those regulations down. And that's why the repo market had to be bailed out last September, all the way through February. And then we had the bailout for the coronavirus. The global monetary system is addicted to debt and leverage. And it's caused the greatest wealth inequality in modern history. I'm certain that it was worse thousands of years ago when you had slaves and kings. But the wealth inequality from the top 1% to the second percent, it's like 30-fold. Think that through. I'm a 2%er. I'm not even completely financially secure yet. So when we take a look at all this, I broke down in this article, there's 3 types of investors. Break it down. I think that there are those who are bullish on President Trump. I think that there's those that are bearish on President Trump. And I think there's those that just want to ride. And I've been getting calls from a handful of legacy clients who just want to ride. Hey, it's going up. Make me more aggressive. It's not what they said 4 months ago or 5 months ago. It's not what they said a year ago. But it's going up now. It's going up. The market's not going up. You got like 30 or 40 stocks that are going up. It's not even 50 or 60 anymore. Breath turned negative in the last 2 weeks, 2-1. Decliners, right, to advancers. So within the just want to ride crowd, we have 3 different groups. And I've talked about this repeatedly. If you got your indexers who just plot along, tripping into stocks long term, they're sort of your baseline investors, whatever they are, 20, 30% of the market. Got your young investors, your so-called Robin Hooders, kids on Reddit, who discovered that they could buy fractional shares with their $100 deposits every month. And then they're like, hey, I can buy a call. So I get a lot more for my money if I buy a call. And stocks only go up. How can I lose? Can't possibly be an entity out there called hedge funds that might screw me over at some point. That can't exist. Government won't let it. Ha ha ha. Fooled you once, gonna fool you again. Securities and Exchange Commission doesn't care who the sharks are. Doesn't care what the sharks eat. As long as the sharks don't get caught directly in a net, that they know where it is, that never moves, and nobody really looks at it anyway. There's no regulation in these markets. Are you out of your mind? You have to be an idiot that basically says, oh, I did insider trading to get caught insider trading. To get accused of collusion because your buddy called the other buddy who called the other buddy, and they're all hedge fund managers, say, hey, I'm going to make this trade, but let's do it right here all at the same time so that this security causes that derivative to do that thing. We'll sell stock so that our futures options make money. And yeah, we'll take a little haircut on the stock, we'll double or triple our money on the futures options. Because we'll be the match that lights the correction handle. Then everybody floods out. So that 5 or 10% that we lost as we started the collapse, we make 100 or 200 or 300, 400, 500, 600% on our futures options on the futures contracts. If you don't understand what I'm saying, you're not completely aware of how the market works. And that should cause you some pause to think about what exactly is the underlying market structure. And I've showed the charts and I've talked about it before. The underlying market structure is this. The marginal investor out there are the traders. Yeah, chat rooms full of hundreds of day traders who all go into the same chats and are on FinTwit. But the hedge funds to control 30 or 50 or $100 million, right? If you're under $100 million, you don't get much scrutiny. But if you're managing $30 million, you're making $300,000 a year plus a percentage of the profits. So you're pretty motivated to make profits. Think any of those guys cheat? Think they talk to their buddies in the other hedge funds and say, hey, what can we do to make a big trade? How do I get my 20% of a $10 million gain? 10%, whatever, 15%. That's the range, 10 to 20%. The reason I'm having a talk on Saturday about opening a hedge fund is because the environment right now is that we can kick your ass. And I should have been doing it because the euphoria is here. I didn't think it was going to happen this way. I didn't think the millennials were ready to go nuts. But you've heard me say for a couple of years, the millennials are going to have a comeuppance. They've never had one. They grew up in a decade-long bull market thinking that was normal. What's normal is what's going to happen the rest of this decade. We are going to test the lows again. Will it be this year? I don't know. Be next year? I don't know. But you'll see an S&P 500 around 2,000 again. But I also think that we're going to see an S&P 500 around 4,000. And ultimately, about 10 years out, 12 years out, somewhere in there, after we finally fix some things, we'll get a sustained bull market. I believe it'll be tied to Social Security or some other government entity, maybe a sovereign wealth fund, I don't know. But I think at some point, yes, the government in some way, shape, or form starts to buy stocks. It's not happening yet. It's still illegal. But don't think for a minute that that Social Security lockbox might not exist someday. Because it is the only sensible thing to do. Either that, or we just allow there to be some sort of sovereign wealth fund of some sort. So all different ways to structure it. The Federal Reserve is already a sovereign wealth fund with what they just did. They got $6-7 trillion on their balance sheet now. A whole bunch of it is corporate bonds. They can't be paid back, so therefore have to be turned into equity. The restructurings of the zombie economy, it's going to take another 5 years because that's how long the duration on the bonds are. Now, maybe they extend those bonds and the Fed balance sheet just stays huge. Maybe we go the modern monetary theory route, and we just keep doing monetization of the debt. At what point does that destroy the dollar? let me ask you this. Many of you have traveled. When the dollar is strong, a lot easier to travel, isn't it? A lot easier for you to buy stuff. When the dollar is weak, things get more expensive. And we're a group of investors. We're all in the top 20% for the most part. What about the next 20% that barely has any money in their retirement plan? And then the bottom 60% that's basically financially net worthless. Financially, they have nothing. What happens to them when the dollar gets weak and their food costs more money? Their utilities start to go up. They're already month to month. Think about what's happening with people right now that they don't have their extra unemployment check. Did anything change for them between June and August from a work standpoint? We know we can look at the economic indicators, which we've done. We know that the recovery has flattened out. Numbers show that. Again, very small marginal improvements. And yet we're still way under where we were in 2019. We take a look at the vaccines. You have AstraZeneca that has a vaccine that's delivered on the back of a cold virus. And it appears that you're going to get 2, 3, 4 months of heightened protection from a severe coronavirus. Won't prevent it for the most part. Will prevent it from really hurting you bad. Well, what's hurting you bad? Well, currently, although about 1% of the people die from coronavirus, a full 1/3, Dr. Fauci just talked about, have ongoing and maybe permanent conditions. So while you're only 1 in 100 likely to die if you're healthy going in, you're 1 in 3 likely to have ongoing respiratory or organ issues. But that's worth going out and having a beer, not wearing your mask at Walmart. Everything that I have said about this since day one in February has happened. Everything. The only thing that I've gotten wrong is hedging my bets on this rally. I made the mistake of believing that reality mattered, that valuations mattered. And in the long run, they will. But in the short run, I should have rode the bubble. So now people ask, should I get in now? And I say, if you're a superstar trader, you can trade anything. If you're not a superstar trader, the very simple question to ask yourself is, do you understand the technical trading things that we have in this one article? All right. Do you understand this stuff? If you don't understand these items right here, you're not a superstar trader. And I see people talk about, well, I'm ratcheting up my stop losses. Hey, that's great. But given that most of the moves happen overnight and prices can open way below where your stop loss was, doesn't matter. Just doesn't matter. And that's why when people ask me which I should have my stop loss at, and they're saying, well, I have like a 1% stop loss. So what freaking difference does it make? The market is allowed to open 10% down. There's not much point having a stop loss It's much different than 10%. I tell people all the time, have your stop loss between 7 and 12%. You have to accept that's how much you can lose, because a limit down open, that's what happens. Just doesn't matter. You think you have stop losses? Look at how many days opened up 1,000 points down. It's going to happen again. Now, when is the question? You know, I showed all these charts. We're in the euphoria range. We're in the greed range. The put to call ratio is stupid. The skew, right? Nobody's buying puts, and yet the puts are expensive. Think that through. That's a jagged up market. We had overbought signals again. People say, well, but it's not as high as over here. Well, take a look at 2018. You had your first overbought. And then before the fourth quarter, it only got, right, this high again, this high again. Yet the fourth quarter was horrible. Why? Because some technical damage had been done over here. It's not going to get as overbought the second time. So we shouldn't expect this to get as high as this. It's close to as high as it's going to get. So whether you prefer money flow index like I do, right, or RSI, you shouldn't expect it to get as high the second time as it did the first time in a condensed period of time. You have the MACD. This was a huge oversold. It made sense that we had some rebound. Usually the retrace is about 50%. And now MACD is trying to turn over. But it's basically done it a couple times and come back up. So could it go like this and come back up? Absolutely. But you still have to ask yourself the question, given the overvaluation, given the borderline overbought, given that there's a clear hunk of the population unwilling to invest their money right now, another hunk that's just never going to reinvest their money, the foreigners who brought their money to the United States, put it in money markets to get dollar exposure, they're not going to stay forever. They got their protection. Some of them flipped into QQQ. That was a big driver at QQQ, actually, I think. Most of the ancillary numbers indicate that. You have to ask yourself the question, how much risk am I willing to take? I don't have a lot of people talking about risk right now. I don't hear it. I have more people asking me, how do we get in now? Where were you 6 months ago? I tell people all the time, if you want me to manage your money more aggressively, you call me, and I'll send you an email based on what we talked about. Then you send me an email back saying, yes, I'd like you to be more aggressive. Right? I have to CYA, CMA. So when I start managing money again here in the next couple of weeks, I have a plan. I'm going to tell you my plan, so you can either hire me or you can just do it yourself. My plan is this. I'm going to see if this market gets more overbought in the next month. And if it does, I'm going to go from market neutral, which is where I've been for several months, to an outright bear. I haven't been bearish. People say, you're bearish. I'm not bearish. I've been market neutral. I haven't lost anything. Kind of moved sideways the last few months. All the while, the time value on all these options I sold was going away. I'm going to have cash to invest starting the third Friday in September. I actually have a bunch of cash. Well, I'll have more cash, but something's going to get called away. Then I'll have more in October. I'll have more in December. And I'll have more in January. Remember back when I said sell long-dated covered calls and stagger them? There you go. You don't have to be perfect when you play the field. Anybody play craps? It's a 50-50 game. I just took the time value knowing some of my stuff would get called away, some of it won't. And all that time value is money that falls to the bottom line as the option expirations get closer. Sometime later this year, much like the end of 2018, I believe, I'm going to get real long the stock market. I'm not going to hedge. I'm not going to take much leverage because you don't have to take much leverage if you're in the right sectors. Think about the things that we picked out. QQQ. All right. QQQ. And ARC. And GDX. TAN. Those were the big four. So let's compare it to the S&P 500. We'll go year to date. Actually, let's go last 6 months. Your yellow line is the S&P 500. Let's get rid of all this stuff. Let's make it real easy to look at. I can put those lines back in. All right. S&P 500, the last 6 months is basically even. 20, 25, 37, 50%. The four funds I picked out. Asset allocation is most of your equation. Because you can want to be a superstar stock picker all you want, but I'm telling you, the folks that you folks that have 30, 40, 50 stocks, you're doing it wrong. You're just doing it wrong. Have half of your money in ETFs, have a good asset allocation, and then only pick out stocks that can beat the stock market by 5 to 10 points a year on average. If you buy a stock that you don't think can beat the stock market by 5 to 10 points per year, the hell are you taking individual company risk for? These are all going to keep beating the S&P 500. Now, are there some doozy corrections coming? Yep, probably. All right, lately we've seen it in the gold stocks, right? Chopping along. Gold stocks chopping along. Alternative energy has been the big winner. Why? Ask yourself why. Who's investing in alternative energy? What generation? If the millennials vote the way that they invest, Biden wins in a landslide. And these investments are going to keep doing well. And a lot of them started very undervalued for the growth rates. A lot of them are overvalued now, but not grotesquely. Not as grotesquely as the 100 to 150 zombie stocks in the S&P 500. We're going to see stocks from TAN or PBW, to the extent that these are American, right? PBW. Is this one? There you go. Look, there you go. There's your big winners. So what we know is that the things that have done well typically continue. And you shouldn't expect that to change. Most of the folks on this call are not millennial investors. Most of you are Xers and boomers, and a few of you are older than that. The boomers do not control the stock market anymore. And right now, there is this weird balance of power that tips it in favor of the traders. Oh, the traders. When these traders start to pull the plug, and the big ones I think are just starting, they're trying to figure out what I'm trying to figure out is, can they cause the most pain by pulling the plug on this option expiration, which is today, or do they wait one more month? I'm not sure. That's what I'm watching. I'm not a big enough guy to manage it. But I think I'm going to raise 30, 40, 50 million pretty quick. And that's what we're going to do. We are going to react to this market. We are going to buy the 20 or so stocks that are going to be the big winners in the next decade. The ones that have been in favor, that also have good balance sheets and good growth. I really don't want to own Tesla. I will get enough Tesla through the part of my portfolio that is ETFs, because Tesla is in QQQ and it's in ARK. I think it's in TAN, PBW, right? I get ancillary, I look at those portfolios. But the 20 stocks I buy are going to be mid caps and small caps that are growing, they have good finances. We'll probably get into a bigger index down the road, which means that there's forced buying by the indexers, right? So we use the indexers to our advantage. I've fallen behind the market 3 times in my career. This is the 3rd time. And every time I kicked its ass coming out. Now, I did spectacular in the financial crisis because we basically broke even. And then the folks who are still in it, we actually made 90% in 2009. We more than doubled our money in 12 months. I don't know if that's going to happen again. But if this goes one of the ways that I think it could, yeah, there's a double opportunity in the next couple of years. If it doesn't go that way, you know, and it ends up being a bear market, there's just a ton of money to be made in that too. So either way, we'll go either way. Stock that I bought this morning that I'm going to send on alert, I just bought a little bit of Walgreens. Somebody tell me why I would buy Walgreens. It's pretty easy. If there's a vaccine, what happens? People line up at Walgreens, right? There'd be lines out the door. Whose candy bars? And cosmetics, bags of chips are going to get bought. There's lines out the door because 300 million people are going to get a shot. maybe 2 shots. CVS is all right too, but Walgreens is really undervalued. Is this the right symbol for CVS? Yeah. Alligator jaws. I know some pretty smart people who are accumulating Walgreens right now. So I just started to buy it. Just 1%, 2% of the portfolios. But the run from here, I'm calling that a bottom, to this 0.618 line. I get rid of that comparison, so I have just the prices. Pretty easy to see it getting into this 618 line, 55. But this one, the extension, up to around 80 bucks a share. And by the way, they're paying a dividend. And by the way, there's investors that want to buy the company. Yeah, that's right. Already had offers. Board of BOD said, hey, board of directors said, it's not enough. I think this one doubles to 80 in the next 2 years. Does it set new highs? I don't know. We'll see. But if we're entering an era where we have to get more shots more often, right? Think of all the people who didn't get flu shots in the past. I never did until I turned 50. I just got a flu shot, first one last year. I'll tell you what, I am so tired of being cooped up. I was never really afraid of the flu killing me when I was younger. I don't even know that I ever really had it that seriously. I've been out of commission a couple days. A lot of those one-day things where you wake up with that funny feeling. By the middle of the day, you're curled up in a ball. But the next day, you're walking around, and by the third day, you're like, I hate when that happens. But this one, 1% likely to kill me, 1/3 likely to make me have to do special things for a very long time, maybe forever, take care of my health. I'm getting the shot. So if every December, every October, whenever it is, if I have to go get a shot, I'm going to shot. Now I'm going to Costco because I just love my Costco membership. But Walgreens, right? 80% of the population ain't paying $65 to belong to Costco or whatever my membership costs. I don't know. So I'm buying Walgreens right now. I'm going to send out an alert when this is done. Maybe send it out tomorrow. I'm just going to let people know that I'm buying Walgreens. So you're on the call. If you got money in your account, do some reading. I'll write an article on it. I'll have it out this weekend. I'm buying Walgreens. So I think it gets to somewhere between 55 and 80 in the next couple of years. Here's the other thing I'm doing. I showed you this the other day. I'm going to short 3 oil stocks. I'm going to short Continental Resources. They've already shown that they're in trouble. And what we're learning from OPEC is that they're never going to let shale off the mat. OPEC needs the money. They're not going to let us off the mat. And if Biden wins, he's not going to care because he's going to push us towards alternative energy, and he'll be okay buying oil from the Middle East if we have to increase our barrels per day by 2 or 3 million. And by the way, Canada, the tar sands, you have to understand, they're already in existence. They're not that expensive to operate. Now, doing a new tar sands project, which I don't think they have anything scheduled for, and they might not have anything scheduled ever again, is expensive. But the existing tar sands are cheap to operate. horrifically bad for the environment, but they already did the damage. So we'll just get more oil from Canada. I don't think we're going to build any more pipelines either. So we'll just, maybe there'll be more trucks. I don't know, more trains. I see trains come through Milwaukee all the time in Canada. Lots of oil. Sat and watched one train go by. I think I put the video on. I was late for a poker tournament because oil cargo train was going by on my way to the casino in Milwaukee for World Series of Poker. There was like 115 oil cars. It was amazing. So, continental resources is in the Bakken and in Oklahoma. What do we know about Oklahoma earthquakes? Do you think that a more stringent Biden EPA is going to be good for those earthquakes? Right? Devon Energy, Niobrara. They're screwed. Devon should have merged with Marathon when they had the chance. Colorado's already got counties opting out of oil. What are these companies going to do with all those leases? Accidental. I don't know how Hullab still has a job. I really don't. I think at this point, Icahn just knows he's going to end up part owner of the company. I think they probably do a take private, him and Buffett, at about $2 or $3 or $4 a share. I think Accidental gets down that low. I'm also shorting Exxon. And I'm really just buying puts, January puts, that's all I'm buying. A little bit out of the money, a little bit at the money. Somebody says Canadian oil sands is dead, and that's bullshit. They're not doing new projects, but they're producing all kinds of oil, and it costs them a nickel to put out another $1. So if we need 2 or 3 more million barrels from the Middle East in the medium crude, and we need 2 or 3 more million barrels from Canada for heavy crude, and our demand slowly tips over, well, I wouldn't say even slowly, but pretty rapidly by 2025, 26. Doesn't matter. Mexico's got oil. What would it take to cut a deal with Venezuela? Reach out to Venezuela and say, hey, be nicer to your people who buy your gold, will help you rebuild your stuff. I think all we have to do is float that idea, and either the people in power take the deal or they get kicked out of power. They've been at the edge of that for a while. Trump hasn't been interested in making the offer. China and Russia have been controlling things. How easy is it going to be for us to flip that equation? That's how fast. While we have no love lost for some of the people in the Middle East, the reality is the way that you prevent World War III is by not being a jagoff all the time. Sometimes you got to cut a deal that's just better than not cutting a deal. Unfortunately, the current deal maker hasn't done a good deal yet. I think most people understand that. He's not really a Republican anyway. I have no problem with Republicans. I work for John McCain. In any case, I'm going to short these 3 companies because of the oil basins that they're in, because the horrific mess that their balance sheets are in, because the price of oil is never going to get much past $60 a barrel, which means that they can't ever pay down their debt. They can't. It is mathematically impossible for these 3 companies to pay down their debt at $60 a barrel. And oil's been stuck around 40 for a while now, right? Had the rebound, got to 40. The traders know, unless there's a big war that disrupts things in the Middle East, price of oil is not getting back past 60 again. And if Biden wins, these companies aren't going to get the sweetheart deals that they've got. They just got a massive tax break as part of the CARES Act. They're getting to retroactively write off losses. Right? They got snuck into the bill. The Democrats missed it. And the Democrats are going to try to change it if they win. I don't know how you retroactively rescind a retroactive tax break. I don't know. Right? So, in any case, those are the ones I'm going to short. Somebody's asking a question about Walgreens. Well, the bottom fishing price on Walgreens is 32. That doesn't mean the buy range is 32. You know, we take a look at a lot of these stocks. Pick one. I don't know, what stocks do you want to talk about? Let's take a look at AT&T. Everybody knows I like AT&T because I publish that. Right? Bottom fishing price is down here. Top of the buy zone is here. You buy anywhere in here. Pick one or two spots to buy in here. I just started doing this. So let's take a look at GDX. No, not GDX. Which one did I do? TN. There we go. So TAN. See, what I'm doing with the new charts to make it even easier for you is I have the broad buy zone. Then this is the area that I'm going to buy. So I put in another buy zone within the buy zone. So this is the range that I expect is most likely. And then this is even more likely. I think this is where I'm comfortable buying. Because these prices usually don't happen unless something really bad happens. And the top of these buy zones, those are really just for aggressive investors. This zero price here, right, that peak is a pretty good spot where it might bounce. But if it goes through that peak, you got to look to where the next fib levels are. Here's a 618, right? And you have a confluence right there. So, I mean, could TAN go all the way back down here? Oh, sure it could. Probably won't. But you have to have a catastrophe. Now, if Trump wins, yeah, it might come all the way back down here. I'd have a hard time not buying it in the middle 20s, though. So I'm starting as I replace the charts, as I update them. I'm making it even more perfect for you. Make it even more plug and play. That's what people have asked for. So I'm doing the best I can. But at some point, you have to do your own research. Stop being emotional because, man, the emotions are out of control right now. Something to do with being locked up from a pandemic and a presidential election from hell. You know, biggest unemployment in history. Anxiety among people who just barely had enough to retire. So, in any case, if you can get TAN and PBW on a pullback, you're going to want to. Because those are going to be the biggest beneficiaries of a Biden presidency. So when I short oil, it's for two reasons. One, the big trends against them. Two, I guess it's three reasons. Two, not much Trump can do for them. And three, Biden's going to hurt them. Right? And I guess four. Maybe this is part of the first one. OPEC needs the money. The cheapest oil doesn't have any incentive to allow the more expensive oil to stay in business, right? Most of these companies are going bankrupt or doing take privates or something like that. Harold Hamm said as much, right? CEO. Somebody wants to know about Philip Morris. So back here, I told people to sell it. You can look at it. It's one of my saved articles on Seeking Alpha, right? Author's picks. August 2017, I told people to get out of Philip Morris. Up there. About $67 a share. I think that's a pretty clear trend. Philip Morris is never going to grow again. Ever. Never, ever, ever. Never, ever. When? Never. Philip Morris is junk. Maybe it chops along. Maybe you get your dividend. I think they're going to cut their dividend though. But maybe it chops along. I think it's the best you can hope for from Philip Morris. Again, why would you ever take single stock risk if you don't think it can do this? And if you think it can do that, either you're dumber or smarter than me. Because I think it's going to keep doing this. Smoking's going away. And it's super expensive to change businesses. They have to buy stuff, right? Juul is junk. What was it, $10 a pack now for cigarettes? I heard this last weekend when I was out of town. $10 a pack of cigarettes. Smokers are just taking a hit off the marijuana pipe or eating edibles. They're screwed. And they're never going to catch up in marijuana. Ever. Marijuana has become a very entrepreneurial business. You know why? Because all sorts of people were already doing it, and now they're getting a license to do it. One of the guys I was hanging out with has a CBD license. Why? Because he knows that the CBD people are going to be the first ones allowed to sell weed. There's probably going to be a federal law soon. If your state hasn't legalized weed, it's just dumb. Why? Because people are doing it anyway. You go to Las Vegas, you go to Colorado, wherever. There's more places now. You pick it up on the way out. Do you know the dogs at the airport don't even sniff for drugs anymore? They're all bomb dogs. So unless they're looking for you for something else, unless you're on the list, you can carry edibles back from Las Vegas. Friend told me. All right, we're going to call it a day. It's been an hour. I'm going to go play with the Hulk. And just letting you know, if you're interested in letting me manage a slice of your money, I'll take as little as 100,000 because you heard it here. Normally it's $250,000 or $500,000, but I'm specifically interested in the more aggressive money. People who want to be in the sustainable growth. I'll do all the other stuff. You just don't want to do it. But I'm looking for people who want to give me a sleeve of $100,000 or more. You know, I prefer bigger pieces because I just do. It's hard to deal with so many people. And the deal is going to be that we don't talk any more than we already talk. I'm not going to be your financial planner. If you need a financial planner, go talk to the guy who does it early or hourly and doesn't manage any money. They just put together the plans. And I'll tell you something. The software that the financial planning people use is the same stuff you can get for next to nothing online. All you need is an accountant to bounce ideas off of, and online software. Financial planners are the most overrated people in the world. It's bullshit designation, CFP. So, in any case, that's what I'm going to be doing. And I'm going to give you all the same picks. You can do it yourself if you want. But again, I'm not a table pounder. I'll just tell you what I think and what I'm going to do. Normally, that would be a 1% fee. If you also are subscribing to an investment letter, it'll be 75 basis points, which normally kicks in at $1 million. I don't even take a performance fee. And I'll tell you, it's managing money without a performance fee is a tough business, because everybody wants you to be their financial planning psychologist, and everybody wants your time. And that's what makes it a less scalable business today than it was 10, 20 years ago. Everybody wants it on the cheap. Do it yourself then. I'm trying to tell you how to do it. I'm telling you what I think. I'm telling you how the professionals do it. I'm telling you what the people better than me, how they do it. When I talk about the hedge funds, I'm not making that up. I'm talking to people in freaking Connecticut and New York and San Francisco. My girlfriend gets so mad at me when I'm on the phone for an hour. While we're trying to watch TV on a Wednesday night, 8 o'clock. In any case, I think that this is the portfolio that is going to do spectacularly well over the next decade. I think there's a couple of neat trades that we can make, especially if you're willing to be short the stock market. Not the stock market, but especially if you're willing to have a few hedges on the other side. And I will tell you, the portfolio is still going to be primarily long. I don't want to do too much of this. I really just want the ones that could potentially be home runs, right? I mean, professional shorts do pretty well. And I think that there's about 100 stocks or more in the S&P 500 that we might be able to find some spots to buy puts on, especially as their debts start to come due. So that'll be the catalyst. But primarily we want to be long, because there are things out there that are just going to get a ton of money poured on them. So the Fed is pouring money on everything in the S&P 500. But Biden, he's going to be more selective. So you can't just be in the market. You have to be in the parts of the market that make sense. And I showed you those charts earlier. We picked out all the right stuff. I just hedged when I shouldn't have. Such is life. Such is life. I had aces cracked last night twice playing poker online for an hour. It happens. It happens. Sometimes you miss a bet. Hey, I miss bets all the time in poker. I just missed a bet. The neat thing about the stock market, like poker, there's always a new hand coming. Be introspective, understand the mistakes you made, fix the things that you messed up. Don't get emotional. Don't chase because something's going up. Don't sell because something's going down. Try to be ahead of that. Buy just as it starts to go up. Sell just as it starts to go down. All these people who sold down here, come on. At least I didn't start really saying sell. I mean, granted, I missed a big move. I mean, I got this. But this part, well, such is life. Right? I think my covered calls on TAN, I believe, are at 30. 35? I'd have to double check. 30 or 35. I think they're 35s. So even if this pulls back to here, I'm still getting called away, but I just buy more for the bounce. Maybe I get lucky. Maybe it comes all the way back down to 35. That'd be swell. That'd make my life a lot easier. But there's just different mathematical ways that you handle it as you see what's happening. So if this comes down, I think it comes down as the election poll numbers narrow. So as Trump picks up a few points, and he will, this comes down. Also, as volatility re-enters the market, this comes down. Also, as liquidity doesn't increase, this comes down, right? These are abnormal charts. Historically, we know that this never holds up. It's got to get down to at least about here. And this area in here is not unlikely. And this area down here is at least possible. Again, I'm not so sure that we see the lows soon, but something bad will happen eventually. And we'll at least test them. All right, have a great weekend. Enjoy the weather, wear your mask, and whoever you're voting for, just make sure you do it, right? That's how America works. Cast your vote, vote your conscience. You know what I think. I trust you. I do. All right, have a good day.